Hello everybody, in today's video we will be doing the chapter 15, the relationship between accounting and other business functions. So this is very easy and we'll finish this chapter very quickly. So we are going to study about how accounts is related to various other business functions. Introduction. In the last chapter, we looked at the various financial systems that operate within most organizations. We will now go on to examine how these systems interact with organizations' accounting function. So first we come to purchasing or procurement. So the purchasing department, it is the department which buys the raw material, which places orders for the materials which is required for the business to function. The purchasing or the buying function is responsible for placing and following up orders. It coordinates with the accounting department as follows. So how does it work with the accounts department? Let's see. First, it establishes credit terms. So in order to buy something, mostly the businesses buy the materials on a credit. They buy, what does credit mean? They buy it for now, but they pay later on. You get that? It's basically like taking a loan, not really on the monetary basis, but it is about buying something now and paying for it later. So the accounting department will work with the buying department to liaise with suppliers to obtain a credit account and to negotiate credit terms which are acceptable. So that is the first thing. And then prices. So the accounting department can advise the buying department on the maximum price that should be paid to maintain the margins. So the accounts department helps the buying department about how much money they have and how much price should they negotiate with the suppliers, and they talk about the price of whatever they are buying. And then payment. So payments may be approved by the buying department but are made by the accounting department. So whatever payments or things related to money are always done by the accounts department. So if the purchasing department wants to buy a certain thing, it talks to the accounts department about it and the accounts department pays for it. And it will be approved by the buying department. Data capture, example orders. So orders details will be input by the buying department and details are passed to the accounting department. Inventory. So the purchasing department will consult with the inventory section of the accounting department to determine the quantity of the items already in stock and therefore the quantity required. So it talks about the inventory, that how much material are already there with us and how much material is already there with us and how much more we require. Okay. Budgeting. The accounting department will consult with the buying department on likely costs in preparing budgets. So obviously while preparing budgets you need to consider the buying department, right? So that's what the accounting department does. I hope this is clear. Establishing credit terms, prices, payments, data capture. Data capture is nothing but the order details, inventory and budgeting. Illustration 1. How does the buying department liaises with the accounting department when buying some leather to make handbags from Def Limited? So now we are going to discuss this more practically, how it works. For example, for buying some leather to make the handbags, our business, what does it do? It makes handbags. So first thing is establishing credit terms. So the buying department will advise the accounting department that the preferred supplier is DEF. The accounting department contacts the credit controller at DEF and provides the information required which is needed in order to set up a credit account. And then prices. So the accounting department obtains the cost estimate for the handbag which is being produced by us, and it discusses with the buying department of how much can be paid for the leather in order to maintain a margin. Payment. So the payment for the leather is approved by the buying department obviously, and then the payment is always made by the accounting department. Data capture. Order details for the leather, it will be input by the buying department and the details are obviously passed to the accounting department to check that the price on the invoice is correct or not. Inventory. Before placing the order, the buying department will consult with the inventory section to determine how much suitable leather is already there in the stock. Let's do the test your understanding. Complete the following table showing how the purchase and the accounts department would liaise in the case of a fast food outlet. So I think that's also easy. Establishing credit terms is the same, that we need to the accounting department will work with the buying department and it will talk to the supplier and get the credit account open. And the prices, the account department will advise the buying department how much maximum price should be there to maintain the margins. Okay. And payment, the payment is approved by the buying department and it is made by the accounts department. And data capture, order details will be input, and then we check the inventory. And then for the budget, the accounting department will consult the buying department on how much cost is the estimate, and then the budget will be made. Hope that's clear. Production. So what we saw right now was purchase department or the buying department. Now we move on to the production department. So the production department plans and oversees the production of good. It liaises with the account department as follows. So what does the production department do? First, cost measurement, allocation and absorption. So the production department measures quantities of the materials and time used. The management accountant will give a monetary value for the material and the time that is used. Costs are then allocated and absorbed to calculate the production costs based on advice given by the production department. Hope that's clear. So the production department and the accounts department talk about how much cost must be allocated for the specific purpose of production. And then we have budgeting. The production department will decide how many items of what type are to be produced. The cost of producing these will be determined by the accounting and production department together and incorporated into the overall budget. And then we have cost versus quality. So the production and the accounting departments will discuss the features that can be included in the products and the raw materials that should be used. They should agree with which better quality materials and features which justify the extra costs and discuss how to maximize quality as well as keeping in mind the profit as well. And then we have inventory. Inventory, the production department will liaise with the inventory section to ensure that there are sufficient raw materials in the inventory for the production that is planned. So the purchasing or the buying department bought everything, checked everything and got it. Now the production department is basically the production department starts making the handbags with the leather in case of the previous one. So first the cost measurement, allocation and absorption, and then we have budgeting, and then cost versus quality, and then inventory. XYZ Limited is manufacturing handbags. The company has commissioned a designer to design a new style of handbag, and discussions are taking place about the materials that are to be used and the quantity that is to be produced. So what is the first step? Cost measurement, allocation and absorption. So the production department would estimate the quantity of the raw materials that is required and estimate their cost, and it will together put it with the account department overheads will be allocated to determine the full cost of the handbag. And then we have the budgeting. So the production department, accounts department and marketing department will discuss how many bags are likely to be sold at what price and how many should be produced. And then we have the cost versus quality, which is obviously, as we've discussed in the earlier sections, we discuss about the cost, what would be the maximum cost and what would be the profit margin, quality, everything. And then inventory, which is making sure that we have all the raw materials which are required. Now, so we have seen purchasing department, we have seen production department. Now we're coming to the marketing department. So the marketing department coordinates with the accounts department as follows. So budgeting. So as you've noticed, budgeting is something which every department does because it is really mandatory. So budgeting, the accounting department will discuss the likely sales volume of each product and in order to produce the sales budget. So we need to produce the sales budget. So the marketing department collaborates with the accounts department in order to find the same. Okay. And then we have advertising. So the accounting department will help the marketing department in setting a budget and in monitoring whether it is cost effective. So for example, they could help in measuring new business generated as a result of different advertising campaigns. So this is basically talking about how much we're going to spend for the advertisements of the products. Then we have pricing. So the accounting department will have input into the price that is charged. Often products are priced at cost plus a percentage, even if the marketing department determines the price based on the market forces. They need to consult with the accounting department to ensure that the costs are covered. And then we have the market share. So the accounting department can provide the marketing department with information on how much sales volumes for each product to help the marketing department in determining each marketing share. So in many companies there can be a great deal of antagonism between the marketing and the accounts department because overpricing and cost control. So obviously there will be differences. So in marketing we saw budgeting, advertising, and we saw the pricing, price of the good, as well as the market share, which was how much sales volume was there for each product and etc. Now we have service provision. So companies very often provide services to customers at the same time as sale or afterwards. So companies, they provide services to the customers. So like a computer retailer may charge an extra fee to help customers set up their system. A car dealer may provide car servicing. So all that are the service provisions. So what are the nature of the services? I think this is very basic to understand. Intangibility. What does tangible mean? The word tangibility or tangible means to touch, right? So are services tangible? No, they're not tangible. Can we touch services? We can only feel and we can experience the service, but we can't touch the service. It's not a good. I mean, it's not a product. So services are activities which are undertaken by the organization on behalf of its customers and therefore cannot be packaged for the customer to take away with them. They often have few, if any, physical aspects. For example, a taxi driver provides a service carrying customers from one location to another. The customers do not have a permanent tangible product that they can keep. Now we have inseparability. So which means that we cannot separate the service from the service provider. Like for example, if we get a manicure, we can't separate the manicure from the person who is doing it, right? So the services are often created by the organization at the same time as they are consumed by the customer. For example, a taxi. So a taxi driver will create the service they offer, that they are carrying a passenger to their desired location. The service therefore cannot be easily distinguished from the person or the organization who is providing the service. We can't distinguish it, right? It is not separable. And then we have perishability. So what is perishability? Service which is not being able to store it, not being able to keep it with us. Like once the service ends, it ends. We can't keep it, right? So tangible means we can't touch, but perishability means we can't store it for future. So a taxi driver cannot take a customer to the same location at the same point in time twice. Once the journey is over, the service has been consumed. Now we have variability. So what is variability? Which means that every time the service will be different. Like if there's a teacher and the teacher is teaching the same chapter in 4 classes, it's not true that they'll use the same exact wordings in every time they provide the service. Every time they provide a facial, every time they provide the massage, it's not always the same. It differs, right? So that's what it means by variability. Each service is unique and cannot be repeated in exactly the same way, making offering a standardized service to the customers very difficult. Now we have the relationship between service provision and accounting. So what's the difference between the service provision and accounting? So there are several issues about which the service departments may need input of the accounting department. So the first thing is the charge out rates. So what do you understand by charge out rates? So this is the hourly rate which the company charges the clients. So it should be higher than salary, as it should include a share of overheads. Example, the money which has been used for the training and any profit the company wishes to make. However, if the charge out rate is too high, then the customers will not be using the service, right? So we need to fix a proper charge out rate, which is like how much money they can charge from the customers. Many accounting firms base charge out rates for their staff on roughly 3 times that person's salaries. Next, we have estimating costs. So, what is estimating costs? So, problems arise in determining the amount of overhead to be included in the charge out area. Also, if the service takes longer to provide than expected, the company may not be able to pass on the extra cost, obviously. So, we need to estimate how much cost is there for, like, the overheads which is to be included in the charge out rate. And then we have problem measuring benefits. So, market conditions may mean that the charge out area, a charge out rate contains a very low profit, element. So, that can occur, such a situation can occur in the market. So, the company may question whether it is worth carrying out these services. The problem is that the benefits are intangible and they're not easy to measure, but nevertheless real. Even though the services are real, we're not really able to measure it in exact, value or the benefits. So, a company with effective service provision has happy customers. A happy customer are more likely to buy from the company in future, therefore leading to lower selling costs. But it is very difficult to measure these benefits. So, charge out rates, how much to charge, cost estimation after the overheads, and then problems, measuring the benefits. Moving on, illustration. GHI Limited is a retailer of computers. GHI offers a service to customers whereby they will go to the customer's house and they will set up their new system. So, what are the factors that are supposed to be taken into account in determining the fee which is charged for this service? So, wage costs of the employees, social security costs, transport costs, other indirect costs, how long the job will take, GHI's required return on the service, cost savings due to providing service, fewer calls, fee charged by competitors for the same service, price charged for the computer price is low, then charge more for the service, but if the computer charge is high, then charge low for the installation. All that should be taken care of. Tester understanding. JKL Limited is a car dealer dealing in new and second hand cars. JKL also has a service department which services cars for customers and others. The fee charged to customers will include parts used and an hourly rate for the time spent by the service personnel. So, what are the factors which have to be taken into account? I think you can do it easily by yourself by referring to the previous question. GKL Limited is a car dealer dealing it with new and list the benefits. In the before one we need to list the factors, in the test understanding 3 we need to list the benefits. You can do this also by yourself. That's it, we're done with the chapter. Now let's just do the practice questions. Which of the following is an example of coordination between the purchasing and the accounting department? Determining sales price, no, that's by marketing. Allocating costs, that's done in the production department. Calculating pay rises, that's also not done here. So the answer is A. Establishing credit terms. Which of the following is not an example of coordination between marketing and accounting department? Review cost or benefit of advertising, it is in the marketing department. Pricing, that's also done by the marketing. Assessing market share, that as well. Assessing credit worthiness, that is not done by the marketing department. Which of the following is likely an advantage of providing a good service? Higher payroll costs, higher inventory turnover, economies of scale, greater customer satisfaction. As we cannot see it, it is obviously customer satisfaction. Most services provided by an organization will be created at the same time they are consumed, at that time itself. So what is that? That is known as inseparability. We cannot separate it from the customer, right? It is done at that time when it is consumed. So inseparability. So that's it, we're done with the chapter. For the other videos, please go to the description box below and click on the link. You will be taken to the playlist where I've covered the other chapters as well. Thank you.